Hi everyone, happy 2026 and welcome to AIADA's Auto Talk. I'm your host, Rachel Soleimani. Before we get started, a few reminders. Anyone that has registered for today's program will be receiving a copy by early next week. And if you have any questions, feel free to enter them into the Q&A bar in the lower right-hand side of your interface. Joining us today, we have Kerrigan Advisors founder and managing director, Erin Kerrigan. For those that have not tuned into one of Erin's presentations before, she always has a fun theme to go on with her presentation. So with that, I'll let Erin have the floor so that she can do her reveal.
Okay, thank you, Rachel. Happy New Year, everyone. Thank you, AIADA, for inviting me to kick off this year's webinar series. We are very excited for a productive 2026, and as you will see, believe the buy-sell market will continue to be extremely active. Before I get started, I am honored to share a Kerrigan Advisors milestone. Since our founding in 2014, our firm is humbled to have raised over $10 billion in sales proceeds on behalf of our valuable clients, making Kerrigan Advisors the leading sell-side advisory firm in auto retail. We believe our leadership position is a result of our team's laser focus on achieving each client's personal and financial goals for their once-in-a-generation sale and our unique business model. Kerrigan Advisors is the only firm in auto retail dedicated exclusively to sell-side advisory for car dealers. We like to say, others have conflicts, we have your interests. Okay, with that brief commercial, let's jump into the material for today's session. I thought it only appropriate to employ a college football national championship theme to the meeting. For those who caught the game last night, what an amazing matchup. And congratulations to the Hoosier fans out there, as well as the Miami fans. Both teams played an unbelievable game. In many regards, these two teams and their performance reminded me a lot of the constantly evolving buy-sell market and its inherent unpredictability. At Kerrigan Advisors, we try to predict the unpredictable. We like to turn to the dealers when we do so, who always seem to have a sixth sense about our industry. And we do this, as many of you know, each year with our annual dealer survey, which we published this month. We received over 525 anonymous responses from dealers across the country, and their insights were invaluable as we assess expectations for 2026's buy-sell market. Today, the survey will be at the core of my presentation as I review the results, starting with dealers' business outlook. Overall, compared to last year, dealers are more positive than negative about their business for 2026, with most expecting their historically strong results from 25 to continue this year. Similar to the business outlook, dealers are also more positive than negative on valuation expectations. In fact, 24% of dealers expect valuations to increase in 26. That's a 41% improvement over last year, when only 17% projected a rise. And that's the first improvement we've seen since 21. Also, only 16% now expect a decline. That's a 52% reduction from last year. Now, these results mark an important reversal of prior year trends and indicate a significant shift in dealer sentiment. What's amazing about this survey is how well it often predicts changes in valuations in the market. We have done this survey now for 7 years, and what we have seen consistently with this amount of data is that dealers tend to be spot on in their expectations. By way of example, in 21, 60% of dealers, the most ever, expected valuations to rise. Not surprisingly, we hit an all-time high in blue sky value the next year, according to the Kerrigan Blue Sky Index. The very next year, though, expectations plummeted and valuations began their decline. That is until this year, when we saw dealers project an increase in valuation expectations, and that is the red line you can see on this graph, which we think is a really good sign for 2026. and is also consistent with dealers' positive views on earnings. More dealers now project an increase rather than a decrease in profits for 26. That's an about face from last year's survey results when the inverse was true. In fact, dealers expecting an increase in earnings more than doubled to 32% for 2026, and only 20% of dealers now expect a decline, and that's less than half of last year's results. Once again, dealer survey responses are great predictors of what actually happens in the marketplace, as you can see here. In 21, 79% of dealers expected an increase in profits. That's an incredible amount of dealers saying that they think the next year would be profitable. Well, the next year we hit a peak in industry earnings, after which expectations declined, as did earnings. If past is prologue, today's more optimistic earnings outlook bodes well for 2026. As you can see, the uptick, and that's the red line here. Now, consistent with dealers' renewed optimism, more dealers are seeking to expand their group with the addition of one dealership this year. 32% of dealers surveyed plan to add one dealership over the next 12 months, and that's up 6 percentage points from 22's low. That said, fewer dealers are looking for large acquisitions with two or more franchises. Only 14% are planning to buy groups, down from 31% in 21. Now, these results are in keeping with the tuck-in acquisition trend we saw in the 25 buy-sell market, when the majority of transactions, 65%, were completed by dealers who already had a presence in the market in which they were acquiring. Our survey results are also consistent with the decline in the multi-dealership transactions that we witnessed in 25, when less than 20% of deals included more than one franchise. Now, keep in mind that while dealership group transactions are down from their peak in 23, multi-dealership transactions remain 48% higher than the pre-pandemic 5-year average. So we are still seeing an elevated level of group sales, which we expect to continue this year. In our experience, more group owners are reaching retirement age, and their ability to hand down their sizable operations to the next generation is becoming less viable, given how valuable these groups are and how increasingly complex their operations are, as well as the need to invest in technology and the challenges of structuring a cohesive family business. All of this is leading to more dealers considering a sale, especially when they feel they're at this inflection point where they either need to double down on growth and invest in facilities, or they should look potentially to exit, and that is prompting a lot of families to think about these important decisions. In many regards, the decline in group transactions in 25 is not that surprising, given that smaller private dealers dominated the 25 buy-sell market. Through the third quarter, smaller private groups represent 81% of buy-sells, and that's a record. These buyers are pushing to expand their group to ensure they have the diversification to manage specific franchise risk, and that they have the market scale to enhance their operational productivity, especially by tucking in acquisitions in regions in which they're already operating. What we see is that those in this small group category are working very hard to execute on their growth strategy to get themselves into that top 150 category, because they really see scale as critical to their group's future success. Now, that said, we do expect the largest private and public groups, the ones that on the bottom here that didn't do as many acquisitions last year, we do think they're going to be very active in 26, especially as more sellers come to market, particularly in the southern region. In fact, the southern U.S. represented the majority of the buy-sell market in 25 at 56%. That's a new record. We see the tremendous activity in the South as a reflection of stronger valuations in those markets due to robust population growth and fewer government regulations, which is driving blue sky multiple premiums up and is bringing more of the sellers in these markets to market. Higher supply coupled with high demand is resulting in a lot of activity in that region, though not a national championship. Sorry, Miami fans. Now, like Indiana's QB and his aggressive touchdown in the second half of last night's national championship game, one of the trends we asked dealers about in our survey was their views regarding the aggressive investments OEMs are asking dealers to make in their facilities. Aggressive in our view. It seems a week does not go by without hearing of some new OEM requirement, and this is after the millions of dollars spent to prepare for EVs, whose sales fell short, well short of expectations. According to our survey, 42% of dealers believe real estate and property investments required by the OEMs, including EV infrastructure, will have a negative impact on future profits. Only 13% project an increase in earnings as a result of these very expensive investments, which inherently are depreciating, painting a grim picture on expected overall ROI for these capital expenditures. Now, this is a challenge for the buy-sell market because buyers are almost always required as part of their approval process to agree to an image facility if a facility is not compliant, and yet they often do not expect these buyers to get a return on that investment. As a result, much of the additional spend on real estate, which increases a dealership's future rent factor, results in lower projected earnings and thus lower blue sky values. We expect real estate and image programs will continue to be a hot topic with dealers in 26 and will have implications for transaction values throughout the year. Now, another question we asked dealers in our survey was regarding some unexpected trends in the last few years, and that was regarding AI and tariffs, both of which really came out of the blue for many at the beginning of 2025. Much like Indiana's blocked Miami punt last night, which was a pretty incredible move. When it comes to AI, not surprisingly, dealers are already embracing the new technology, with the vast majority either using or planning to employ AI in their business. This tells us that the future of auto retail will likely look a lot different than the past, as automation of processes and operations overcome some inefficiencies that have existed in the business model for some time. In fact, auto retail net profit margins could rise to a higher normalized level in the future if less human capital is required to make a sale and keep a customer. Another question we asked dealers was regarding the impact of tariffs. Interestingly, 43% of dealers reported no impact on their business as a result of tariffs. That said, tariffs are having some impact on dealers' plans for their business, with more looking to add dealerships as a result of tariffs, 16%, that is, rather than sell, just 2%. That's an 8-to-1 ratio, and that really surprised us. We did not expect that result from the survey. Even with this increased interest in growth, fewer dealers are planning to increase their capital investments as a result of tariffs, and fewer are planning to increase headcount, demonstrating there is some trepidation due to the evolving U.S. tariff policy. Likewise, fewer dealers are seeking to increase their new vehicle inventory and are rather focused on expanding their non-tariff used inventories, which fortunately are becoming easier to obtain with the rising in lease returns starting this year. Okay, in addition to the questions on the overall market, we also asked our surveyed dealers about their views on specific franchises, including valuation expectations and their trust level. While the market as a whole was positive, there were certainly winners and losers in the franchise system, much like the CFPB playoff selection process. Sorry, Notre Dame. Consistent with last year, the majority of dealers surveyed believe individual franchises will either remain the same in value or increase over the next 12 months. That said, the variability amongst franchises and valuation expectations continued to diverge significantly. Of note, This year, every domestic franchise saw an improvement in their valuation expectations for 26, with each seeing a rise in those projecting an increase in valuation. In fact, they were double the average if you took the whole group. So really huge improvements for domestics. By contrast, all imports, both luxury and non-luxury, saw a decline in their upside valuation expectation for 26. These results could be a byproduct of the Trump administration's economic policies that clearly favor U.S. manufacturers. Now, in terms of the highest expected valuation gains and least likely to decline in value, Toyota, Lexus, Honda, Kia, Subaru, and Chevrolet led the pack. Over 20% of surveyed dealers expect these 6 franchises to increase in value in the next 12 months. Now, the survey was interesting because this year, for the second year in a row, the top performers in this category only included one luxury franchise, Lexus, and the others, BMW, Porsche, and Mercedes, instead ranked 7th, 8th, and 9th, respectively. In terms of the highest expected valuation declines, Infiniti, Nissan, Volvo, Volkswagen, and CGR were at the bottom here. Over 50% of surveyed dealers expect these franchises to decline in value in the next 12 months. For the third year in a row, Kerrigan advisors queried dealers about their trust level in each franchise. Toyota again received the top results by far, with 86% of dealers indicating they had a high level of trust in the franchise, about 3.5 times higher than the survey average. By contrast, 64% of dealers reported they had no trust in Nissan, consistent with the expectation of a decline in future Nissan valuation. In our experience, the most trusted franchises are those who are least likely to see a decline in valuation, while the least trusted are largely the franchises most expected to decline in valuation. Kerrigan advisors also asked dealers which franchises they are seeking to add to their enterprise in 26, and these results were very consistent with Kerrigan advisors' proprietary buyer network of more than 1,400 dealers nationwide who are looking for dealerships. Toyota and Lexus are by far the most requested brands by buyers, consistent with this year's survey results. The OEM's measured approach to network size and judicious inventory management remain highly attractive to buyers, making the franchises the most requested in their respective categories. Of note on Toyota, its franchise continues to outshine all their competition and seemingly gets better each year, even when it doesn't seem even possible. Its trust levels have risen every year since we started this survey, and I can think of few companies in the world that can achieve the kind of trust levels that we see with dealers in the Toyota as an OEM and in both of their franchises. This is notable because when you compare the high level of trust category to franchise blue sky multiples, you can see there is a direct correlation. The higher the trust, the more buyers are willing to pay for a franchise because they have confidence their investment will be safe and provide a strong return. Of course, the inverse is also true. The lower the trust level, the lower the blue sky multiple. Now, in reviewing the winners and losers of this year's survey, General Motors is one of the standouts, with all of its brands seeing significant improvement. Specifically, Chevrolet was one of the top performers, ranking 6th in expected valuation increases, up from last year's 12th position, the largest ranking improvement of any franchise. And for the first time ever, Chevrolet surpassed Hyundai in valuation expectations, a dramatic turnaround for both brands, really. More dealers now expect the Hyundai franchise to decline in value than increase, while the inverse is true for Chevrolet. In addition, Buick, GMC, and Cadillac also saw strong results in this year's survey, with a 5 percentage point improvement in valuation expectations and an 18 and 24% improvement in those dealers expecting a decline. Not surprisingly, both franchises also saw dramatic increases in trust levels amongst the dealer body. Another standout in this year's survey, believe it or not, was Stellantis. While some would argue they had nowhere to go but up, Stellantis saw the greatest improvement of any OEM in its survey results related to valuation. The percentage of dealers surveyed expecting lower CJDR values declined by 26 percentage points from last year. That's the largest percentage point improvement of any franchise. Unfortunately, the OEM has a long way to go to return to its 21 valuation expectations, when only 16% of dealers expected a decline in value. But those who own this franchise know that it is usually a roller coaster ride with highs and lows, so potentially we're entering a more optimistic high period for Stellantis. Another notable result to discuss was the Volkswagen Group, which experienced a dramatic decline in survey results this year. Specifically, VW, Audi, and even Porsche saw significant increases in dealers projecting a decline in valuation for 26. In addition, nearly half of dealers surveyed now have no trust in the Volkswagen brand. And Audi's no trust rating increased increased 8 percentage points compared to last year. And Porsche's high level of trust rating declined 8 percentage points, which is the largest negative move of any franchise in that category. Kerrigan Advisors expects the Volkswagen Group's global economic challenges related to the rise in Chinese OEM market share, both inside and outside of China, are having major implications for the brand, in addition to the U.S. tariff policy, which is particularly punitive to VW, given its minimal U.S. manufacturing base. With this in mind, and consistent with our survey results, Kerrigan Advisors made several changes to our non-luxury blue sky multiples in our most recent reports. Specifically, we increased the blue sky multiples for 3 domestic franchises, Ford, Chevrolet, and Buick GMC, and decreased the multiple for VW. We also upgraded CJDR's multiple outlook from negative to steady, and Hyundai, Nissan, and VW remain negative, consistent with their weak survey performance. In the luxury segment, we downgraded Audi's multiple last year. The franchise continues to see market share contraction, and a rising share of its dealers are dissatisfied with the OEM, as seen in our survey results, resulting in lower buyer demand. Also, in light of GM's improvement, we upgraded the multiple outlook for Cadillac in our third quarter report. Cadillac sales increased 19% through the third quarter, and their day supply is below average, industry average. And that's a big turnaround for Cadillac from prior years. We expect Cadillac could see its blue sky multiple increase in the fourth quarter. In closing, the constant changes in the auto retail market remind me a lot of college football today, which is also undergoing a complete transformation with the transfer portal, NIL funds, and the ever-evolving CFPB selection process. I think Coach Curt Cignetti said it best: it's balls to the wall all the time. You're getting better or getting worse, never staying the same. What I see in the auto retail industry is quite similar. There is no room for inertia anymore. Dealers and OEMs are in a balls to the wall moment to ensure they are always getting better and being nimble, because steady state will likely be a failed strategy going forward. Thank you very much for tuning in to this webinar today. I hope to see all of you at NADA next month, either at the Auto Team America Buy Sell Summit on February 3rd from 8 to 1. You can register online, or probably even register when you come. I think there are a few more spots left. And I will be leading a dealer panel at that summit, which will be really an interesting discussion about growth and why to grow and how to grow your group. And then I'll also be leading a workshop at the convention this year, The Evolution of the Automotive Buy-Sell Market, on February 4th at 3:30, along with my friend and colleague, Stephen Dietrich, who's an exceptional buy-sell attorney. So I hope to see you at either one of these events. And more than anything, let's make it a great year. Thank you very much.
Erin, thanks so much for your time today. I know you've got a lot on your plate this time of year, as we can see right here. Everyone, be sure to check out Erin at these workshops. You will not be disappointed. But Erin, thank you. We always appreciate having you on.
Thank you.
To those on the line, you'll all be receiving a copy of this presentation and recording by early next week. To learn more about AIADA, visit aiada.org. Thanks for joining us and have a great day, everyone.